5 thoughts on bank runs. With Silvergate, Silicon Valley, First Republic, Signature, it's certainly causing a lot of rumbles in the economy right now, and 5 thoughts that we wanted to share, at least some perspective on it. So the first question and first thing people think of is, why would a bank have exposure where something like this could happen? And so 2 things to think about there. 1, more generally speaking, is either mismanagement or bad loans. But 2, and what you'll see in a rising interest rate environment, is a mismatch of duration. And so if you have CDs in a bank, so to speak, where they're paying customers 3-month, 6-month, 1-year CDs of 4 or 5%, yet they have long-term treasuries on the books that are generating 1, 2, 3% less than 1%, then you have this mismatched duration of both from a timing perspective as well as interest rates. And so as interest rates rise, prices of fixed income, treasuries, or whatever a bank may have as its securities and collateral, or just loans in general, will be marked down if there are fixed interest rates. And so you have a decreasing collateral pool while you have an increasing need to give out money to keep deposits in base. And so this misalignment of interest rates and duration creates a great deal of exposure because banks are having less and less collateral as rates go up. Less and less collateral as rates go up because their collateral base is valued at that much less. And so the question is, why then would customers run? Why would there be a bank run? And so the simple answer to that is they don't have trust in the bank. And that might be because they feel the bank has exposure to these bad things, if they have some insight into that, or they may just feel that so many other people are taking their capital out of the bank that they need to get theirs out as well. And we'll circle back to this concept of what's insured and what's not insured. But fundamentally speaking, when the confidence of the consumer is lost, everybody just wants their money back. Next thought is the risk and reward of lending in general. And so when a bank is giving out loans, you can think of it as a situation where they have a limited upside in the sense that they will get a certain level of interest, but they have an unlimited downside. If the ultimate borrower defaults or goes bankrupt, then they can end up with a 0. And so when you have these limited upside, unlimited downside scenarios, a bank needs to be very prudent in terms of who it's lending to. And so Silicon Valley Bank had a reputation in particular of lending to people that couldn't get loans otherwise. And part of this was the thesis that they were more entrepreneurial, more interested in supporting venture-backed situations, more risk tolerant, but risk tolerance only makes sense when there's adequate reward for that risk. So when you have a limited upside scenario and you just take on more and more risk, if you're not being compensated for that risk, then it's just foolishness, right? Something's either cheap, or when you look at something in the world and you say, boy, that's cheap, it's either cheap because no one else has noticed it and it's special and it's a great opportunity, or it's just accurately priced because it's not good, right? And so a lot of banks, in particular, I think Silicon Valley had a lot of exposure to this, is that a lot of their loan book may just not have been good stuff. So the next thought is, why did the government then ultimately step in? And obviously that was to stop a cascade of these events from taking place. And so you remember back in the Lehman Brothers, Bear Stearns, when Merrill Lynch had to be saved, and you're seeing the same thing happen now with very large banking institutions, even if they're not some of the very, very large, bulge bracket, JP Morgans and people like that. Government wanted to shore up confidence in the banks and therefore stepped in to effectively guarantee the deposits via the FDIC, via some convoluted structure. Very difficult to tell if the taxpayer is ultimately on the hook for these things. It's the expression, is a rose if by any other name, right? Is it a bailout if we call it something different? Unclear. But irrespective, good thing that depositors are going to retain their money, but equity holders, bond holders of the institution are likely to be wiped out, both their Signature. First Republic, I didn't look at the structure of the investments being made, but you have to believe they're cramming down a lot of the equity or debt there. So the government stepped in to protect the borrowers, not to necessarily protect the owners or management of the bank. So then that leads to the last thought here, is twofold. Was this a bailout? And also, should the FDIC be expanded? What I mean by that is the FDIC currently limits bank account protection at $250,000. And anything over that has exposure. But any situation where there's too large of an institution that's failing, the FDIC appears that it will have a willingness to step in and secure any excess over that. And so it starts to harken back to the '08 too big to fail situations. That was more so on the company side. This is more so on the depositor side. But the same concept comes to light: is should the depositors just be protected for any amount, or does that create a moral hazard for the operations of a bank? Right? Someone once said that the best type of government support is the support that no one actually believes is there until it's actually needed when the government steps in. The implicit knowledge that support will be there makes people take more foolish decisions, right? And so I think a lot of perhaps the idea is that banks would take that much more risk if it knew that all deposits were guaranteed. But if the FDIC is going to step in any situation like this, should it disproportionately punish small banks? It's a hard conversation to have. You like to see laws kind of applied consistently across the board. You certainly don't like to see depositors harmed in any way when it's their hard-earned company and individual money in these accounts. And the last question that will continue, and I don't think we've seen the last of this question, is was this a bailout? And going back to that same concept of the money has to come from somewhere. The government's main means of money is tax. So is it taxing other banks? I heard they're moving it from one bank to another in the sense of regulatory fees from banks that they're using to deposit here. I have to study it more. I candidly, I'm not an authority on banking regulation, but anytime money goes away and it needs to be found and the government finds it, there has to be some thought that this is money that will either be taken from other institutions that then passed on the expenses to the consumer, or it's just being directly taken from tax money. But I think the jury's out on that one. And so interesting things to think about. But these are at least 5 concepts that have come to our mind that we've discussed internally at our firm relative to bank runs, kind of their impact up to this point, and I think to some extent the prudent actions of the government to prevent it from rippling or amplifying throughout the economy. So that's the thought for today. Keep pushing forward. God bless. We'll see everyone next time.